Let's see here. All right, so obviously tested the top of the market maker's expected move with a 69.10 test. That put us right at the very fucking tippy top of the gamma curve. Rejection there, leading to a close back below, pretty sure gamma max. Yep. Yeah, close back below gamma max, which should be expected. That's the standard behavioral pattern. It's very very rare to close above gamma max simply because the market maker is just selling so heavily at that point that mean reversion back to gamma max is common. However, remember that gamma max can shift during the intraday, and the zero DTE max of gamma is probably a better indicator of where the potential range is for the day rather than the weekly. But the weekly does act as a pull as well because you start to move to the upside of gamma max and the market maker starts dumping delta. That's why it's mechanically improbable to close above it. However, we do have FOMC tomorrow. FOMC is a really big deal. Obviously, the market 100% expects the Fed to cut. The underlying reason for that, labor data. However, the ADP labor data they were expecting to receive is not being made available to them, and they will no longer be making a report available to the Fed. They will, however, still continue to release their monthly report, and they will be continuing to release or they will start releasing a weekly report of higher frequency data on private payrolls. But the current analyst expectation is that the Fed is going to cut on the presumption that the labor market is continuing to weaken despite all of the recent reports showing a bit of a recovery in labor demand. This is still the analyst expectation. Inflation was largely unchanged. Core didn't move up as much this month, but it still moved up. And then headline moved up a little stronger. And we have no PPI data. And the Fed, they've promised to be data dependent, which they do not have right now. I think many of the Fed members were already uncomfortable with the prior cut. I think even more are likely to be uncomfortable with this one. And I would say that there is at least, in my mind, a small potential that tomorrow the Fed simply pauses. It might be a dovish pause. Sure, that could stabilize things a bit. Could be a hawkish pause. Unlikely. I think if they do cut, it'll have to be another hawkish one, very. And then, I think rates at the top end of the curve are going to move up. Demand for duration is going to shift further out onto the curve, and that's going to also demand higher volatility hedging, and the demand for the premium over on volatility tends to drive the yield of that volatility higher. And the more duration people carry, the more of that long volatility exposure that they need to also carry. And that kind of thing can have a very negative impact on equities specifically. Um, Obviously, another Fed cut could further weaken the dollar despite its recent stability. It should probably be a lot lower than it actually is. And then we're also dealing with the fact that, deficits are already quite high, and lowering the cost to borrow at this point in time is probably even though they're not supposed to be interconnected, probably would be a big mistake on the side of monetary policy. Easing fiscal policy when fiscal policy is already completely fucking out of control doesn't make a whole lot of sense. And if JPOW really wanted to keep a single shred of credibility that he has, his best decision would probably be to try to maintain the federal funds rate where it is until he is removed from office. However, the rest of the Fed board members are not so neutral in in their stance, and many have shown their desire to be influenced by the party in office, and so a rate cut is definitely still possible. I mean, the only thing he has to care about is his legacy. I would say at this point, that's we did set a new all-time high today on ES, continuing the breakout, 69.4450 it looks like, 44.75. A little bit of a pullback into the end of the day. You know, rejection marked at 69.17, a failure marked at 68.90. Those are the two levels of the downside. Upside, you know, the all-time high is resistance, and then beyond that, pretty much blue sky. As we continue through this cycle of price improvement. There are two gaps, at least one very big gap to the downside of spot. There's two gaps to the downside of spot on the SPX. There might be some liquidity demand to fill those on any kind of failure, which does actually present quite a lot of range to the downside. So that should be noted. However, because of the risk of buying puts in an environment like this and earnings coming up, the Trump decision coming up, the Fed decision coming up, I would say that if you want downside protection, the best bet is probably still, you know, something risk defined like a spread, where you can cover, you know, a target range, but you don't have as much exposure to theta and a little bit less exposure to price improvement, which is what makes buying puts here scary. Also, VIX isn't very low. Like VIX has stayed relatively high through this push up, especially given the supposed confidence. So I would argue that confidence is built on a little shakier ground than our last upside push, where, you know, VIX was falling back into like the 14, 13 levels. Yields dropped across the curve again today, still showing some demand for bonds, especially going to the FOMC meeting. That kind of makes sense if anyone wants to hedge. A rate cut, they'll probably want some bonds. Dollar down a little bit as well today. We've seen dollar drop over kind of like the last 3 days, which is part of what's driving, you know, the tech stocks higher, although it's probably not driving much else higher. Correlation, however, turning around pretty hard today, especially into the end of the day, both on the 1 and the 3 month. Sorry. And I believe we found a new all-time low for 1 month correlation. Well, very, very close to like Jan, Feb of 2025, I think here. No, not quite. I guess we could go a bit lower. Still very low, and the lowest this year, so which has been quite a bullish year, despite the crash. And 3 month correlation also turning around in kind. So, you know, as we move into these big tech earnings, there's a chance for some of this dispersion to be overloaded, and the market makers will simply dump delta regardless of the outcome of the earnings. This tends to happen when all the stocks run hard as fuck prior to actually announcing earnings. Then even if they beat, they usually go down because the market makers are at that point so long volatility that pretty much any price action at all drives them to dump delta, which we saw in the last earnings season. That's kind of an interesting effect that people should probably be apprised of, which it leads to a lot of like very flat Mag 7 earnings. It's been happening for a few quarters now. Commodities, oil down, gold down. Gold did bounce off the 3,900 level where I said it would yesterday. I think breaching back above 4,000 might be a little difficult. There's probably going to be some shorts there. I figured they would come in at 4,000, crush it to 3,900, and then bulls would finally get a foothold. That's kind of exactly what happened. But if gold does break out above 4,000 again, it's going to fucking rip. So keep an eye on that, especially if rates get cut tomorrow. Central banks are loading up gold. So is China. It's a very good dollar hedge. And if they cut rates, The expectation is that the dollar will drop. Agricultural commodities doing really well today too. Oil just shit in the bed. I don't know if we fucking made peace with Putin or what the hell's going on, but it's down. I wasn't really paying attention to macro, like geopolitical macro today. Um, Correlation turning up on the 3 month, but still no move in bond volatility. You probably won't see one. This is interesting. Leverage on the carry trade falling off, which is usually a bearish signal, and forward yield on volatility throughout the day actually higher than it was yesterday. Pay attention to this. If you guys need the chart formula, they're all right here. You can screenshot this, so you can get the front and the back end of the carry curve. This is global exposure in this, so the spreads are a little bit different. If you want to look at the true spread, you can change the plus to a minus, and that's, US dollar to JPY. This is probably a better indicator of like Dixie to JPY, but that's not really relevant right now. What's important here is that leverage is falling off at both ends. And generally, when leverage does that at both ends, we see the 10-2-year climb, which we're seeing. If bond demand is picking up, then the forward yield for volatility is going to pick up as well, because they have to hedge those bond portfolios. And the fact that we have a higher yield on volatility today than we did yesterday probably says something, especially given the price improvement. It looks like Skew dropped like a rock yesterday, so big bull. Interestingly, breadth kind of flattening out here a bit. Even with the move up in NQ, 20-day movers not really rising very much. Looks like 50-day, above the 50-day moving average actually fell off a little. So that's interesting, and could also be a sign of reversal. Volatility climbing today. We've noticed that correlation has continued up over the last 4 days, despite volatility going down. However, today showed quite a big bump in volatility. VIX up 3%, VIX 3-month up, well, VIX up 3.8, VIX 3-month almost 3, and VX up almost 3. This turnaround in volatility, especially at such high prices, usually indicate short calls getting squeezed. However, I think in this scenario, it might actually be short vol pulling back the rest of their positioning, probably de-risking into the FOMC meeting, and then also de-risking into the Trump-Xi trade talks, which are expected, I believe, Thursday, Friday. Probably don't want to be short a ton of vol into either of those events, because the outcomes, the other side of the coin on those is quite risky. Interestingly, this is like the 5th consecutive day now that Fed fund futures have priced in lower chances of future rate cuts. I do think that if J-Pow cuts tomorrow, that they are going to probably take the December cut off of the table. Especially if the government shutdown appears like it is going to persist. So, like I said, if they cut, it'll have to be really hawkish, and I think that's the way to make it most hawkish. The other really important thing to consider here is RRP. RRP was up a little bit today. More counterparties, I think, like closer to like 15 billion. But it would be extremely strange at this point in a rate cutting cycle, unless the market was not confident that the Fed was going to cut, for RRP to start loading back up. And so adding a little bit of liquidity buffer there before the FOMC makes sense. But if we continue to see RRP rise, that would probably be very concerning, especially with everything as over levered as it is right now. 10-2 continued to fall below 50. And the SOFR spread picked up even a little bit more, now at 12 points from where it was, I believe, at 9. That's a liquidity problem. And this is one that'll be addressed by the Fed in a different way. This is, when is QT going to end? And if QT does end, are they going to resume quantitative easing? This is a big question. We've seen some liquidity shocks over the last couple of weeks. Obviously, like with the failure of Tricolor, First, whatever, in these smaller regional banks and these over-leveraged auto lenders. Obviously, there are some liquidity shocks in the system, and generally, where you find one of these things, there exist many, many more. Those are just the first ones to crack and the worst managed. And so that might be something that's still a persistent risk. So I would keep an eye on this, a very close eye on this, because if the SOFR spread continues to widen, that can be quite bearish, and present some serious short-term liquidity problems. Even more so if the Fed doesn't end QT and continues their pace of roll-offs as they are now. Remember, the bank reserves are getting to levels where they are no longer as robust. Mega cap tech surge sparks most negative breadth at an all-time high on record. Yeah, we just talked about breadth. Also, another interesting thing, this is our second day up on declining liquidity, like declining leverage, which could be like kind of a blow-off type situation. Generally, when leverage goes down, the S&P follows suit. Leverage is going down right now, not up, and so that's an interesting thing to pay attention to. I will say it does tend to have bigger drops around OPEXs, but we're a couple weeks out from one of those, so leverage going down in an upwardly mobile market is a little bit concerning. Out here, we kind of retested the top of that prior growth trend that we failed here in October. That kind of crosses over above the longer term, 2024 trend. But we did test my my upside price target for SPX, which was 69.10. That was kind of a pie in the sky estimate of where this could go. I'd be very interested to see if the market reversed off of this. There's quite a few gaps to the downside, and a retest of the 20 MA or 30 EMA is definitely possible from here, which represents like a almost $200 pullback. That could be quite fun. I think that's about it. Oh, wait, I wanted to show you guys this. Look how fucked the rest of the market is. We've literally got fucking like 6 companies holding all this shit together right now. And like, yeah, they got a lot of market cap, but they don't have as much market cap as literally everything else. They're not 50% of the S&P yet. Looks normal, no Ponzi here. Yeah, the AI circle jerk clearly has not yielded any returns in market cap. Because why would a company giving away money to be spent at their own company not go up in value? I'll leave you with that.